Hello everyone, here is the answer to exercise 2 for unit 3 in AC201. I am going to be working in Excel today for ease of getting this assignment done in a timely manner, and I'm doing this live, so if I have a little flub up, I'll try my best to correct it. Let's start by looking at our company, Coleman Cable's adjusted trial balance, and trying to figure out what classification we're going to put all these accounts under on our balance sheet. So cash, again, current assets are things that the company expects to use or expend within the next year. Well, I'm thinking since cash is already cash, we're going to use any one given dollar in the next year. That has to go under current assets. Accounts receivable, same deal. People owe us money for normal course of business, so we probably sold some kind of inventory to them. We expect them to pay us within the next year, so we have to classify that as a current asset. Next up, we have allowance for bad debts. An allowance for bad debt is a contra account tied to receivables, so it has to go in the same section as accounts receivable. So we're going to put that under current assets. Next up, we have our notes receivable in the short term. Well, that's amount of money we let somebody borrow. This is short term, we expect to be paid back within the next year, which means that is also a current asset. We have raw materials inventory, and raw materials inventory is goods laying around that aren't made into a product. In our case, in the finished cable, there's plastic or wiring sitting around that we're going to use later to construct those cables, which means that's going to be classified as a current asset. Next up, we have WIP. Well, guess what? If raw materials inventory is a current asset, WIP inventory is going to be a current asset as well. And by that same logic, finished goods inventory is going to be a current asset because we expect to sell any one finished unit of cable within the next year. So that is our list of current assets. The next thing we have is preferred stock investments. And there's different ways that you can classify investments in another company, depending on how long you want to have it for. But we could just assume here that this preferred stock investment we have, we're not hell-bent on selling. We're going to hold on to this until we make a profit that we want to. And since we don't have any, intent of selling it in the very immediate future, we're going to classify this as a long-term asset. And in this case, we can call this a long-term investment. After that, we have buildings, and our building is going to be something our business is going to use to make a profit in the future that we expect to have for more than 1 year, which means it's going to be a non-current asset, and the classification that we're going to put it under is property, plant, and equipment, our PP&E. All depreciable non-current assets like a building will have an accumulated depreciation account tied to them, and it has to be reported on the balance sheet in the same spot as the account that it's tied to. So if buildings is going to be under PP&E, then accumulated depreciation in buildings also has to go under PP&E. Our production equipment, again, is something we plan on using for more than 1 year, and it is a plant asset, so it also has to be PP&E. And after that, we have our accumulated depreciation of equipment, which has to go in the same place on the balance sheet that we listed equipment. Well, if we listed equipment under PP&E, we're going to list accumulated depreciation of that equipment also under our property, plant, and equipment. The next two that we have on here are our copyrights and our goodwill. So copyright is, something that we are going to use to turn a profit in the future. It is not a financial instrument, it's not a loan, it's not an investment in stock or bonds, and it has no physical form. And therefore, when we classify it, we're going to classify it as an intangible asset. So that one's going to go under intangible assets. Underneath that, we have goodwill. And goodwill is a strange kind of concept, but essentially what it is it's the premium that Coleman Cable paid when they bought out a competitor. So when that happened, they wanted to have that competitor's name, that competitor's customer list, etc. Those things have value to our company, but again, they don't have a physical form and they're not financial in nature. They're not stocks and bonds. So goodwill is always going to be an intangible asset as well. The next thing we have is our salaries and wages payable. And I think our employees are going to expect us to pay them within the next year. And we owe them this money, so it's a liability. And since we have to pay it within the next year, it is a current liability. Unearned revenue is a job that we have to do for someone who has paid us in advance, so we owe them something, we owe them work. And I think our customer is going to expect us to pay them off within the next year, or finish this job within the next year, so we're going to classify that as a current liability. Interest payable is next. And interest payable is the amount of interest that's owed on our outstanding loans, in this case our notes, which means when we classify this, we have to pay that interest the next time we make a payment on our loan. That's going to be a current liability. And we have notes payable in the short term, that is borrowing that we have to pay off within the next year, so that's going to go under current liabilities. After that, we have notes payable long term. So that's a long-term loan that's going to take us more than a year to pay off, so we're going to put that guy under long-term debt. Bonds payable are, financial instruments we sold to investors. We said, let us borrow some money, we'll make a series of interest payments to you and then repay you that chunk of money you let us borrow way down the line. And bonds can be for a lot of different periods of time, but traditionally bonds are usually always at least a year long, so we're going to classify that as long-term debt. We have discount on bonds payable. For one reason or another, we decided to sell our bonds at a price below the stated value on the bonds. Well, when we did that, we sold them at a discount, which is a contra account to our bonds payable. We have a contra liability here, and like all contra accounts, it has to appear right next to the account that it's tied to on our balance sheet. So discount on bonds payable, or if you have a premium on bonds payable, are always going to be reported as long-term debt. Moving on, we're moving into our equity accounts here. Common stock is the amount of money paid in by external parties to buy ownership in our company that can be attributed to the par value of our stock. It's going to go under equity. PIK common, paid in capital in excess of par from common stock transactions, is the amount they paid above par value when they sold our stock, but that's also going to be an equity account. We have retained earnings. That's the amount of our own internally generated profit that we are holding on to. Still going to be an equity account. We have treasury stock, which again is our own common stock that we bought back from the public. But since it deals with our own personal common stock, it's not an investment. It has to go under equity. And then lastly, we have equity attributable to a non-controlling interest. So someone is owed a portion of our equity. We probably have a subsidiary that's not wholly owned, which means part of the value of our company can be attributed to these other parties outside of the company. So anytime you have a non-controlling interest, a portion of your equity has to be attributable to them, which means it goes in the equity section. Now that we've decided where every account's going to go on our classified balance sheet, we have to prepare the balance sheet. And the numbers sometimes aren't enough. People are going to want further disclosure about our information. So on the right hand side, we have a few points that people at Coleman Cable want us to disclose on the balance sheet. The first is the company is restricting $12,500 worth of cash for plant expansion that will not begin this year. The next is that Coleman Cable has $250,000 worth of 12% 5-year bonds, which are due 4 years from now. Third is that Coleman Cable's board of directors has authorized 40,000 shares of their $2 par common stock. 33,000 of these shares have been issued, and the public currently owns 32,000, so that's the amount of shares that we have outstanding. So we're going to need to disclose that information in our balance sheet to our users, which we are going to do in the footnotes. But let's start by filling in our accounts. The first section we have, start on the asset side, and we're going to start with current assets. Again, if we go back to our list, we see that our first current asset was cash. So we are going to put cash into our current assets. So let's take about 5 spaces to start with, and we're going to put this in the left-hand column because it's going to have a contra account tied to it. How much cash does Coleman Cable have? Go back to our information. We see they have $225,000 in cash. Next up, we got to account for that restriction that we have. Coleman Cable is restricting $12,500 worth of plant expansion, which means of that $225,000 in cash we have, it's not all free cash. So we need to disclose to users of our information that some of that is restricted. So what we're going to do is inform them that we have cash restricted for plant expansion. And that amount is going to be $10,000. And let's put it right underneath. So now, sorry, that amount's going to be $12,500. Let's put that underneath, and now we got to disclose the amount of free unrestricted cash that our company has. Well, it's just the difference between those two numbers. If we have $225,000 and $12,500 of it is restricted, that means we have $212,500 in cash, which is unrestricted, freely available for anything. I think people are going to want to know a little more about this restriction, so we're going to do this. After the end of the account, we're going to put a little footnote citation. So in our notes, we can disclose even more information about this, and we'll call that item A. So let's put a little A after cash restricted for plant expansion. The next account that we have on the list over here is our accounts receivable, which has a value of $35,000. Well, let's go and let's throw that into our classified balance sheet. We have accounts receivable, and accounts receivable has a balance of $35,000, and that is our gross receivables. That's the total amount of receivables that we have on the books, but we don't expect to collect every single one of those receivables, which means we got to disclose to users of our information what portion of those receivables we think are going to be uncollectible, which we can find on our adjusted trial balance, because that is our allowance for bad debt. So just like we did with this restricted cash earlier, we are going to go through and we are going to list our contra account here that's going to reduce its value, which is our allowance for bad debt. And of this $35,000, the information just told us that we don't expect to collect $3,000 of it. So we need to tell our investors that of that $35,000, we expect we are only going to be able to collect or eventually see $32,000 of it. The next item that's on our list, let's see what we got. We have notes receivable in the short term. So if we go back to our balance sheet, let's put that on here. Notes receivable, short term. And the amount of notes receivable we have in the short term, according to our adjusted trial balance, is $10,000. So when we put this on the balance sheet, it doesn't have any contra accounts tied to it, and that's what the left-hand column B over here is for. So since there's nothing tied to it, we're going to put that number right into the center column, 10,000. And then if we go back to our list, we see we have 3 inventory accounts. We have WIP, we have raw materials, and we have finished goods. Well, let's list all of those on our balance sheet. And to do so, I'm actually going to start with just a little header that informs our users that, hey, this is our inventory section. So let's call this inventories, and that's it. And then we're going to go down and disclose our first one. And typically when you list inventory, you list it in the order of liquidity, how fast you're going to turn it into cash. Well, what's the first type of inventory we're going to sell? It's going to be our finished goods inventory. And if we go and we look at our balance, or our trial balance, we see that for finished goods inventory we have 30,000. So let's go and fill that number in. We're summing something up here. We're doing some calculations. So we're going to put this in the left-hand most column as well. After that, we have our second most sellable type of inventory, or at least closest to being sold, and that is our WIP inventory, our work in process. If we go to our sheet over here, we see that we have $12,000 in WIP. So let's throw that number in here. And then after that, we have our raw materials inventory. So we're going to list that as well. And our raw materials inventory, according to our adjusted trial balance, is going to be $24,000. So let's go and put that number in as well. And if we have $30,000 worth of finished goods, we have $12,000 worth of WIP, and we have $24,000 worth of raw material inventory. Well, our total inventory is worth the sum of those three numbers, which is going to be $66,000. And looking at our trial balance over here, that's all we have for current assets. So now we're ready to go and list what our total current assets are. And I usually move this one a little bit over to the right. It's going to be our total current assets, which is equal to the sum of everything in the center column. Coleman Cable has $320,500 worth of current assets. We are still in the asset section. Let's move on to our next classification, which is our long-term investments. And the first one is pretty easy. It is going to be our preferred stock investment that we have in another company. So let's list that on our balance sheet. Preferred stock investments. And there's no account tied to this, so we just bring the number over. We see here that we have $35,000 worth of preferred stock investments, so we're going to move that number on over to the center column. I can line it up in the right row. There we go. And we actually have another long-term investment. What is it? We're investing in ourselves. We are restricting $12,500 worth of cash for plant expansion, but we're not going to start for the next year, so we're holding on to that money for the purpose of investing in ourselves in the future. So we took it out of cash above. Well, we have to put it back in somewhere, and that somewhere is going to be right here. So we're going to list our cash restricted for plant expansion, and that is going to be equal to the $12,500 that we restricted above. And that's all we have for this section. So our total long-term investments, wow, let's try that one more time. Our total long-term investments are going to be equal to $47,500, which is the sum of these two numbers. Our next classification we're going to move on to is our PP&E. We go to our statement here and we see that we have 4 accounts ready to go in PP&E. They are our building, its accumulated depreciation, our equipment, and our equipment's accumulated depreciation. So let's just save some time right here and fill those all in at once. We have buildings, and to that we have to list the accumulated depreciation of those buildings. Our other plant asset was our equipment, and we have to disclose its contra account, which is going to be the accumulated depreciation of that equipment. So let's put in accumulated depreciation of equipment. So now we got to throw in our values. Let's go and look and see what we got on our information. We see that we have $625,000 worth of buildings, and those buildings have been depreciated by $225,000. So let's throw in those numbers. There's a contra account tied here. We have some calculations to do, so we're going to list them both in the left-hand column. Our accumulated depreciation was $225,000. Well, we're going to make that negative because it's reducing its value, which means the book value of our building at this current time is $400,000. That's what our books are saying this building was worth. Next up, we have our equipment. So let's go and see our numbers there. And we see that our equipment has a historical cost of $235,000, but we've depreciated by $140,000. So we're going to throw those numbers in over here. $235,000 is the historical cost. We've depreciated it by $140,000. Let's make that negative, which means that its book value is its historical cost less how much it's been depreciated by. So we are saying that our equipment is worth $95,000. And since that's our only two things that go in this classification, we can put our total in. And I'm just going to put total PP&E. You could put total property, plant, and equipment if you wanted to. It's fine too. And that is going to be equal to the book value combined of both of our pieces of PP&E. In total, Coleman Cable has $495,000 worth of property, plant, and equipment. Underneath this, we have our intangible assets. So let's go and see if we find some of them on here. And we did. We have two. We have copyrights and we have patents. Copyrights are $45,000. The goodwill, I'm sorry, not patents, is $80,000. So let's bring our copyrights and our goodwill over to our balance sheet. We have copyrights. No contra accounts tied to these, so we're going to put them right in the center. Copyrights are worth $45,000. We have goodwill. Again, no contra account tied to goodwill, so that's worth $80,000. And if we add those two together, we have total intangible assets equal to the sum of those two numbers, $125,000. So Coleman doesn't have anything that they want to disclose as an other asset, which means that's the end of our assets. So we can go through here and we can figure out what Coleman's total assets are by taking the sum of the totals for the different classifications, which we conveniently put in the right hand column, so it can just be the sum of this column. Coleman has $988,000 worth of assets, which means we can move on to our liabilities. So let's start with our liabilities, and we're going to start with the first one we have listed. We have salaries and wages payable. Okay, we can throw that up into our balance sheet over here. Let's make that happen. We have salaries and wages payable, and the amount of salaries and wages payable that we have at the current time is $16,500. Again, nothing to total, no contra accounts. We're going to put it right in the center column. Looking back onto our thing, we see our next account that we have is our unearned revenue of $111,000. We really owe someone some work, so let's throw that in here. Nothing tied to it, no calculations, goes in the center column. After that, on our information, the next thing that we have is interest payable of $4,500. Well, let's throw that up in here. We have interest payable, which is for $4,500. And then our last current liability that we have listed here is our short-term notes payable. So that's got to go into current liabilities as well. And that is notes payable in the short term. And that number was for $4,000. And since that is the only four current liabilities right here that Coleman has on their books, we can total that section up. We have total current liabilities equal to the sum of those four numbers, and since it's the total of a classification, we're going to put it in the right hand column. And it was 136,000. Next up, we can move on to our long-term debt. So for our long-term debt, we look and we see we have three things. We have our notes payable in the long term, we have our bonds payable, and we have our discount on bonds payable. Well, let's go through and put the note in first. So here, under long-term debt, we're going to put our notes payable in the long term onto our balance sheet. And that number, if we go look at our information one more time, was 105,000. So let's put that number over here. The other piece of long-term debt that we have is our bonds payable, and it has a contra account tied to it, which is our discount on bonds payable. So we're going to list both of those. We're going to start with the regular account, which is bonds payable, and that had a balance of 250,000. And it's going in the left-hand column because it has a contra account tied to it. And we are going to subtract from that the discount on bonds payable. And the discount on our bonds payable, according to our information, is currently 25,000. So we're going to subtract that out. And when we do that, we're going to find that our bonds payable right now have a current value on the market of 225,000. Well, if we add those two together, and by those two I mean our note and the book value of our bonds payable, we're going to get our total long-term debt. And our total long-term debt is equal to the sum of those two numbers. So let's add that together. And that's 330,000. We know our current liabilities, we know our long-term debt, so we know what our total liabilities are, and that is just equal to the sum of all of our different classes of liabilities, which is just these two, 136,000 and 330,000 added together, means that Coleman Cable has $466,000 in total liabilities on their books. So we can move on to the stockholders' equity section. And back to our information, we see we have a bunch of equity accounts. The first thing that we have is common stock, and underneath it we have PIK common. Well, those are two different classifications. The first one that we're going to use is we're going to disclose to users of our information what our amount of capital stock is, which is, in other words, is how much of our equity is attributable to the par value of the stock that we issued. And that is going to be our common stock. So let's list that. Let's go find its value. And our common stock has a value of 66,000, so we're going to put that number in. And we're going to put this in the left-hand column as well, because we're going to have to subtotal it up here in a second. $66,000. To that, we need to also disclose what our additional paid in capital was. And again, that's the amount of money that investors paid above the par value of our stock, which is where we're going to place our paid in capital and excess of par account for common stock transactions. And we're going to go through and we're going to look and we're going to see that PIK common has a value of 364,000. Not uncommon to have a way higher PIK value than your capital stock value. So 364 grand. And if we add these two together, we're going to get our total paid in capital, the amount of capital that our company has that can be attributed or is due to to the fact that we sold stock to investors, and we raised $430,000 by doing so. So that's one portion of it. The next thing that we have is our retained earnings, which is the amount of money that we are keeping from our own profitability, and our information tells us that Coleman Cable has retained earnings of $98,000. So let's go and throw that into here. We're going to put that one in the center column. And then we have one more equity account that we definitely got to worry about for right now, which is our treasury stock account, which is a contra equity account. It decreases the value of our equity because equity is what the business is worth to your investors in total. Net worth of the business, well, that's not equity that's available to them because we're holding on to those treasury stock shares. So let's go and let's take that treasury stock and let's subtract it out. At the time, our information tells us that we had $18,000 of treasury stock on our books. So we're going to get rid of that. And now that we know what our paid in capital, our retained earnings, and our treasury stock was, we can have our total equity that is attributable to Coleman shareholders. And that amount is going to be equal to the sum of those three different types of equity we just had right there. That is $510,000. That is the value of our business for our stockholders. But they're not the only people that have a stake in our business, because if we go back to our information, we see that we have equity attributable to the non-controlling interest. So let's go through, let's go back to our information, and let's come up with our equity attributable to non-controlling interests. And the amount of equity that we have that is attributable to our non-controlling interests is $12,000. So we're going to report that in the right hand side as well. One more zero, there we go. So what do we have next that we can come up with? We can come up with our total stockholders equity, and that is going to be equal to the portion which can be attributed to our stockholders plus the portion that can be attributed to the non-controlling interests. In total, we have $522,000 worth of stockholders equity. Put a border back in there. There we go. So now we got to make sure that our books balance. And what we're going to do is figure out what our total liabilities and stockholders equity are. We had $466,000 in liabilities, and we had $522,000 in equity. So in total we had $988,000 of liabilities and stockholders equity, which is good because we balance now. Our accounting equation is in check. Our balance sheet is good. All we have to do is fill out our notes. So again, to our information, there's only three things they're asking us to disclose. One of them was the restricted cash, which we already put the note in for, was A. The second one was information about our bonds. Coleman Cable has $250,000 worth of 12% 5-year bonds, which are due 4 years from now. Well, we gotta let people know about that, so let's go to our bonds payable and let's put a little B after that. We're gonna call that note B. And the third thing that we have to disclose is that Coleman Cable's board of directors have authorized 40,000 shares of $2 par common stock. 33,000 shares have been issued, and 32,000 of these are outstanding. Well, let's go. And let's put that next to our common stock, because that's what that information is about. We're going to call that C. And now we can go fill in our notes. And I'm going to drag this information right down so we can look at it while we're filling in our notes. So, note A that we had up here was due to our restricted cash. So let's go fill in our notes with an A. And we got to let people know what we have. So we can say that Coleman plans to begin construction on an expansion to the plant 2 years from now, semicolon, $12,500 is restricted for this purpose. If you just want to copy and paste on your assignments the notes I have written for you, that's totally fine with me. You don't have to reword them. As long as the information's there, you're good. The second thing is we have to talk about our bonds. We have $250,000 of the 12% 5-year bonds, and these bonds are going to mature in 4 years, so let's disclose that. Coleman's bonds are 5-year bonds that pay 12% APR and mature in 4 years. Information disclosed. And then the last thing, and this is a note that everybody has, investors are going to want to know what the breakdown of your stock is. How many more shares could you issue? How many shares do you have out there? How many shares do you have in treasury? So you need to disclose that information. So we're just going to say that Coleman has 40,000 shares of $2 par common stock authorized, 33,000 shares issued, and 32,000 common shares outstanding. And it gives a little more information to our investors. Again, in the real world, you're not going to have just 3 lines. You're going to have pages and pages of notes, but it's the concept that I want for right now. So let's mark things and move them down. Have a good day, folks.